Greetings, everybody. Welcome to Liberty Call. Today is Friday, March 3rd, 2023. Hope everybody's having a fantastical week out there. Much better day in the markets from the way it looks. Got a lot of green on the screen. I guess some people are hopeful that the market's going to turn around in the short term, but we shall see what happens over the coming weeks. I know there's been a lot of cheerleading from the financial journalists for the Fed to stop their rate increases. But and I know some of them came out and said, "Well, no, we're going to stay with half or was it half or quarter? I forget which." But we shall see what happens long term. All righty, if it's your first time watching the Liberty Call, please give me some thumbs up, likes, shares, subscribes, follows, whatever else. Click these little buttons down underneath my screen. And all right, well, let's go ahead and jump into the numbers and see how things turned out for the week. The Dow Jones was up today 1.17%, closed at 33,390. S&P 500 was up 1.63, closed at 4046. NASDAQ up 1.97, closed at 11,698. The VIX fell 5.72%. It's at 1847. Canada was up 1.2, Brazil up 0.46, Mexico up 1.56. Our friends across the Atlantic, Germany, they were up 1.64, UK flat, up 0.04. France up 0.88, Netherlands up 0.72, Spain up 1.47, Italy up 1.56, Switzerland up 0.22, and Portugal up 0.9. Russian exchanges both in the green today. MOEX up 0.79, RTSI up 0.3. And the overnights in Asia, starting with the Nikkei in Japan, it was up 1.56. Australia up 0.39, New Zealand down 0.24. In the Chinese markets, the Shanghai was up 0.54. The SESE component barely up 0.02. China A50 up 0.31. DJ Shanghai up 0.39. Hang Seng up 0.68. Taiwan weighted came in a smidge up 0.06. All right, so that's everything as far as the markets for today. Let's take a look at the indexes for the week. Let's start out with the Dow Jones. Looks like it's going to finish the week off up about 1.45. S&P 500 is going to finish the week off up 1.32. NASDAQ is going to finish up 1.68. The Dow Utilities finishes the week off down 1.61. And the Dow Transports finish off up almost 2.5%. So not a terrible week. I mean, we had a lot of back and forth with the with the markets, but not terrible. All right, well, let's go ahead and take a look at the daily chart and see how things are lining up. This goes back to the beginning. This trend line goes back to the beginning of January of last year. We can see we've been in this steady downtrend. It's been down as bad as at most for the S&P, about down 24. Currently from its peak, it's down about 14. So it's made up about 10% on this current rally that goes back to the fall. Just looking at these other charts here, or the other charts down here, the momentum, the relative strength, and the stochastics, everything seems to be in a downtrend at the moment. So my personal guess is that we'll continue this downtrend probably until the trough will probably be somewhere around 18 months from the beginning. That's just typical average. So somewhere in that ballpark, maybe mid-year is where I'm kind of anticipating where things should turn around. But I go by the charts, so what the charts tell me is how I will handle things. All right. Let's go ahead and get into the economic data that was reported this week, starting out with initial jobless claims. They came in at 190,000. Forecast was 195. Last week's number was 192, so right in line with the previous weeks. U.S. continuing jobless claims came in at 1.655 million. Forecast was 1.665 million, and last week's number was 1.660. So dropped a little bit from last week by about 5,000, so not too bad. Again, trends look fairly normal. U.S. durable goods orders month over month fell 4.5%. Forecast was a drop of 4%, and last month's number was a positive 5.1. So that's a pretty big swing between those two measurements. The consumer confidence index came in at 102.9. The forecast was 108. So That's a bit off. And last month's number was a 106. We dropped. We've been dropping for the last couple of months. From what was that, November was the lowest, then December was up, and then it's been sliding down the last 2 months. The ISM Manufacturing Purchasing Managers Index came in at a 47.7. Forecast was 48. Last month's number was a 47.4. So it did creep up a smidge. And with this ratio or chart, anything below a 50 is basically a contraction. Anything above 50 is considered a growing economy. The U.S. Services Purchasing Managers Index, PMI, came in at 50.6. Forecast was 50.5, so a tenth of higher than forecast. And previous month was 46.8. So we did have a nice jump for this month. All right, well, that's everything as far as economic data that came out this week. Let's go ahead and go to our market recap for today. S&P 500 in search of first weekly win in 4 weeks as rates retreat to boost tech. Let me get my notes. The S&P 500 index rallied on Friday, seeking its first weekly gain in 4 weeks as U.S. Treasury yields retreated from their decade-high levels. The benchmark 10-year Treasury yield fell below 4% after hitting its highest level since 2010, despite strong data indicating the expected return to growth in the U.S. services activity for the first time in 8 months. This data suggested that the U.S. economy remains resilient enough to withstand further rate hikes from the Federal Reserve, even though strong economic data has caused investors to rethink how much more tightening is needed to materially slow the economy. Investors are now forecasting the Fed to lift rates to a terminal rate as high as 5.46%, well above the 4.95% last seen at the end of last year, according to a note by Stifel. Growth sectors of the economy, including consumer discretionary and technology, both of which are vulnerable to rising rates, benefited from the fall in Treasury yields. That's probably why tech was up so much today, or the NASDAQ. Tesla, the electric vehicle maker, was the biggest gainer in consumer stocks following data showing that demand in China rose after the company cut prices. Tesla's monthly sales climbed 13% to 74,402 vehicles in February, according to preliminary data from China's Passenger Car Association. In tech, Apple rallied more than 3% after Morgan Stanley reiterated its buy rating on the stock, citing underappreciated catalysts, and that's in quotes, such as iPhone and services gross margins near all-time highs and future product launches. Meta Platforms, formerly known as Facebook, was also on the rise more than 6% after the social media giant cut the price of its virtual reality headsets at a time when Wall Street continues to talk up the company's potential boost from artificial intelligence. C3 AI Inc., an AI enterprise company, reported fiscal third quarter, or should be fourth quarter results that beat both Wall Street's expectations, driven by new business and the expansion of partnerships, sending its shares up 33%. The company also delivered upbeat guidance, with management reiterating their target to reach non-GAAP operating profitability by the fiscal fourth quarter. Semiconductor stocks also pushed tech higher, underpinned by more than a 5% jump in Broadcom after the chipmaker delivered stronger than expected guidance and quarterly results that topped estimates. The chipmaker is well positioned for a soft landing, according to UBS, as positioning in high-end networking and computer offload should prove highly advantageous as hyperscalers look to rapidly scale AI infrastructure. However, Marvell Technologies took some shine off chip stocks after reporting mixed fourth quarter results and guidance that fell short of estimates as it continues to work through bloated inventory levels following pandemic-led stockpiling. Elsewhere on the earnings front, Costco Wholesale reported fiscal quarterly earnings that beat estimates, but revenue and February same-store sales fell short amid a weaker consumer. Goldman Sachs said it continued to have confidence in Costco's value proposition, which would continue to resonate with consumers, and noted that wholesale retailers management attributed to weakness in February due to adverse weather. All right, so that's everything there. Got some news about oil. Oil sells up on China demand hopes, post a weekly gain. So, and anyone who's been listening to me for a while knows that energy is, the money creation from the Fed is the primary driver of all the inflation we're seeing. The energy inflation, which is kind of collateral damage from that, is really like the driver two behind that, which, if we can get, monetary inflation down, then if, we could see some disinflation in energy, that would go a long way in helping people out across the country. All right. Oil prices rebounded on Friday with Brent crude futures up $1.08 or 1.3% to settle at 85.83 a barrel. And West Texas Intermediate crude futures settled at 79.68 a barrel, up $1.52 or 1.9%. Prices had dropped earlier in the day by more than $2 per barrel following a report that the UAE had held internal discussions about leaving OPEC and increasing oil production. However, they rebounded after two sources said the report was, quote, far from the truth. End quote. Brent and WTI had their third biggest weekly percentage gains of the year as strong economic data from China increased hopes for oil demand growth. China's seaborne imports of Russian oil are set to reach record highs this month, and the country is aiming for a growth target of 6% by 2023. The oil market was unaffected by the 10th consecutive week of U.S. crude stock builds, and a record exports of U.S. crude lent more to support the prices. The dollar also weakened, with analysts expecting it to remain under pressure over the next 12 months. This would make dollar-denominated oil cheaper for holders of other currencies. Meanwhile, the European Central Bank continued to send hawkish signals, with the ECB Governing Council member Pierre Wunsch saying its key interest rate could climb as high as 4%. Woo! Wow, that's crazy if inflation remains high. Analysts also noted that crude prices had been on a roller coaster on Friday, initially falling on rumors that the UAE was considering leaving OPEC before rebounding. Yeah, we already covered that. All right, so kind of good news, bad news. I mean, if you're an investor in oil like I am, and many of my clients, it's nice to have oil be profitable, but at the same time, I like driving around in my truck, and $5 diesel is just not very very awesome. I mean, luckily this week I did have a bunch of Kroger points, and I got to fill up my main tank and my the rest put another 10 gallons into my auxiliary tank, so I got 35 gallons of gas of diesel for $140. So I think it came out to right around $4 a gallon. So now I hadn't gotten gas in my truck since like August. So, I don't drive a whole lot. I'm either here sitting at my desk, or I'm, running back and forth to the grocery store. And half the time I take my wife's car, since it's more fuel efficient. All right. Last up, article from our friends at the Mises Institute. The title is called The Coming Recession Will Be a Global One by John Wolfenbarger. And he writes the Bulls and Bears report. I get it in my inbox. So he's a pretty smart fellow. Let's go ahead and bring up my notes. All right. Over a century ago, Austrian economist Ludwig von Mises, who just that was Rothbard, had a birthday this week. Ludwig von Mises discovered that the boom-bust business cycle is caused by central and commercial banks creating money out of thin air. This encourages businesses to borrow newly created money at lower interest rates to fund capital-intensive investment projects. However, when the money creation process slows, businesses realize that there are not enough scarce resources to complete their projects, leading to their liquidation. This causes short-term hardship and lowers long-term living standards by wasting scarce capital. This explanation of the business cycle is known as the Austrian business cycle theory, which suggests that the only way to prevent the boom-bust business cycle from reoccurring is to prevent banks from creating money out of thin air in the first place. Boy, wouldn't that be nice? This theory was further developed by Mises students Murray Rothbard, who explained that when the government and its central banks encourage the expansion of bank credit, it causes not only price inflation, but also malinvestments and unsound investments in capital goods, leading to underproduction of consumer goods. The government-induced inflationary boom distorts production, injures consumers by raising prices and cost of living, and creates unsound investments. Money supply growth holds the key to forecasting boom-bust business cycle, and Rothbard defined the best measure of the money supply as the Austrian money supply. This measure is shown to be declining in the U.S., as indicated by a 2.2% decline, likely to cause a recession this year. Following a 40% increase in the money supply due to the Fed's COVID response in 2020, money supply growth is also slowing in all major economies such as Europe, China, Japan, and Brazil due to the central bank's boom-bust monetary policies. Global leading economic indicators are falling into recessionary territory, including a global recession. The Organization for Economic Cooperation and Development, the OECD, composite leading indicators for group of 20 economies, including the US, Europe, China, Japan, Brazil, India, and Australia, have fallen to levels only seen during global recessions. This suggests that now is the time to prepare for the bust phase of the boom bust business cycle. In conclusion, the boom bust business cycle is caused by banks creating too much money, leading to short-term hardship and long-term lower living standards. Let's see here. The declining money supply growth in major economies indicates a global recession, and it's essential to prepare for the bust phase now. All right. So again, I know I talk about this stuff every single week. Be careful out there. Get your set your sandbags up around your perimeter so that when the flood comes, your house doesn't, your house and your drywall and your electrical system doesn't go kaput. And make sure you got enough food to get you through to, it's like for people who live along the Gulf Coast, you always want to have a stash of rations just in case a hurricane comes through and you're without power for a week. Same thing. Like I live out here in the mountains right now. You always want to have a little extra food because sometimes you get a blizzard and you can't leave your driveway for 3 or 4 days. So anyways, all right. Well, I hope everyone has a fantastical weekend. If you need anything from me, please go to dsafinancialgroup.com. All my contact information's there. You can book a meeting, drop me an email, or you can give me a call. Phone's not ringing, people. All right. Well, like I said, hope everyone has a great weekend, and I will talk to you guys next time. Adios.